I want to talk about the Fed and the broader economy. A lot of rate raising lately. We haven't gotten inflation back to the target. Do you think they need to do more?
Tom Barkin from Richmond saying Fed policy is right now in restrictive territory, but there is uncertainty around where rates need to go. He said inflation is going to be stubborn, more stubborn than many people would hope.
I think the fundamentals, as far as they're shaping up for a recession, I think the case is extremely compelling for the second half of this year.
Are you curious about the market outlook for 2023? What uncertainties are hovering around the US economy this year? What does the picture of a recession look like? And what will be the Fed's next move? Well, to answer all of these questions, in today's video, Cathie Wood dives deep into the macro picture of the economy. To know more details, stay tuned until the end of this video. And if you want to stay up to date with the latest crypto insights, the markets, and the economy, be sure to hit that subscribe button and the bell icon. Okay, you ready? Let's dive in.
I think when history books are written, we'll look back at this period and we'll see the sharp rise in inflation, which was caused by massive supply chain, really supply shocks from COVID and the war in Ukraine. And you will see, so sharp increase, and it feels like it's so slowly coming down. But when you start looking at these charts in history, this decline will look very like it was very rapid, and we will descend into deflationary territory. Don Luswin wrote a piece, it was an editorial in the Wall Street Journal, I believe, about this. And I think the Fed is going to be blamed for sending us into a deflationary period. Already we're getting negative signs for guidance. Home Depot, its same-store sales down 3 to 5% for the year now they're expecting. We got GDI, which is the other side, so gross domestic income, which is the other side of gross domestic product. And they need to equal, but they're at a record gap right now. It's been negative, so in recession territory for the last 2 quarters. And I think many companies are going to feel a hard landing, and it's going to come both from units and prices. I think more and more companies are reporting this on their earnings report. These economic statistics that take all the oxygen out of the room are hugely lagging, and they're not even getting it right. If you look at the digital world, gross domestic product that statistic was devised in the industrial age. We're in the digital age right now. Yeah. So we pay more attention to gross domestic income, which tends to be more accurate as we're seeing these inconsistencies. You know, with our 5-year investment time horizon and having been around this block a number of times, we know they're going to come to a deal. They are not going to deprive government employees of their paychecks, Social Security, so retirees of their paychecks. It'd be politically disastrous as we're heading into this election year, and already the field has heated up so significantly. So they're going to get through this. It's a very short-term phenomenon. It might be a short-term fix. And hopefully they do get serious about this at some point in time, but we don't think now is the time.
Inflation has been on the rise, and it's primarily caused by the extensive disruptions in the supply chain resulting from the COVID-19 pandemic and the war in Ukraine. These unforeseen events have sent shockwaves through the entire global economy. Seeing the last CPI prints, inflation may seem to be easing slowly now. According to Cathie Wood, Fed's monetary policies aimed at controlling inflation may have unintended consequences that could tip the scales in favor of deflation. Imagine going to your favorite store and finding that everything is on sale, but instead of celebrating, you start to worry. Why? Because deflation can have severe consequences for the economy. It can lead to reduced spending, lower profits for businesses, and even job losses. So it's something we need to keep an eye on. and that drop could drag us into a dangerous zone of deflation. You see, the inconsistencies arising from relying solely on outdated economic measurements are becoming increasingly apparent. It's like using a typewriter in the age of smartphones. Cathie Wood believes that we need to pay more attention to gross domestic income instead of GDP, which tells us more about what's really going on. Let's get into the next clip to hear more from Cathie Wood.
The yield curve is still inverted. Now, it's not inverted as much as it was before the crisis. Before the banking crisis, the week before, the yield curve was inverted by 100 basis points. That means that long rates were 1% below short rates. Long as measured by the 10-year Treasury bond yield, and short as measured by the 2-year Treasury bond yield. With the banking crisis, actually short rates adjusted more than long rates in terms of flattening out the yield curve a bit. We're down to roughly 48 basis points, so it's been cut in half. But long rates haven't moved much since the crisis, so that adjustment has taken place mostly by short rates. Well, the Fed has just telegraphed that it doesn't want short rates to do that. It wants short rates to go higher, at least at this point in time, and they'll keep an open mind going forward. That is a little bit of a change, and so that's good. So that's one market signal. And typically the yield curve, if it's inverted, is pointing to much lower than expected growth. And actually every time in post-World War II experience that the yield curve has inverted, and it inverted way back in July of last year, the economy has entered a recession.
During the banking crisis, short-term rates took the lead and adjusted more than their long-term counterparts. This resulted in a partial flattening of the yield curve. While long-term rates have remained relatively stable since the crisis, the adjustment has primarily happened in the short-term rates. It's like watching a dance between the two ends of the curve, with short-term rates doing the fancy footwork while long-term rates hold their ground. But now, the Fed wants to raise short-term rates again, which is different from what they were doing before. This change in approach is significant because an upside-down yield curve usually means bad news for the economy. It's leading to recession warnings. Let's get into the next clip, but before jumping ahead, be sure to give a big thumbs up to this video.
We are seeing a continuation of bank failures, and what's a little troubling about this is that the administration seems to be, I'm not going to say wanting it to happen. I'm sure it doesn't want it to happen. But what the administration is saying is, hey, banks that made bad decisions, shareholders will be wiped out. President Biden said that when he addressed the nation, I think it was on March 13th. And bondholders will be hurt as well. So this is what I mean by, not paying attention to market signals. Well, if you have investors fleeing banks, this is going to cause the bank prices to go down. And that's exactly what's happened.
The banking sector is in crisis, the US economy is in crisis, and we should be alarmed. Will the market stabilize, or are we in for a bumpy road ahead? Can central banks maintain the delicate balance without triggering effects on the economy? What will the Fed's next decision be? Only time will tell, but one thing's for sure, the uncertainties in the economy and the market are far from over. But what about you guys? Let me know your thoughts in the comments section below. And don't forget to subscribe to my channel for more updates on crypto and the economy. Also, be sure to give a big thumbs up to this video. Thanks for watching, and we'll see you next time. Adios.